Hi, I'm Gary Venner, CEO of IFA Acquisitions. One of the most common questions financial advisors ask when they start thinking about succession planning or selling their business is, what is my firm actually worth? And quite often, advisors hear phrases like EBITDA multiples, recurring income multiples, enterprise value, and valuation ranges without always having a clear understanding of what those terms actually mean. So in this video, I want to break down how IFA firms are typically valued, what EBITDA multiples are, and the key factors that can influence what your business may be worth in today's market. What is EBITDA? Let's start with the basics. EBITDA stands for earnings before interest, tax, depreciation, and amortization. Now, while that sounds technical, in simple terms, EBITDA is often used as a measure of the underlying profitability of a business. It adds back to the net profit figure anything that won't continue after the buyer takes over, so the profit number reflects how the business will actually perform for them. It helps buyers understand how profitable the firm is before certain accounting or financing adjustments. You may also hear the term normalized profit. So this is where there will be a deduction from the EBITDA to account for any new overhead needed to run the business. For example, how much will it cost to appoint an MD or an advisor that replaces the owner? Why does this matter, you may ask? Well, because when an acquirer is buying your business, they are not just buying revenue. They are buying a profitable, transferable business. That is the important distinction. A firm generating strong recurring income but carrying high costs may be valued very differently to a leaner, more efficient business with stronger profit margins. What are EBITDA multiples? Well, once EBITDA has been established, buyers will often apply a multiple to calculate the valuation. Very simply, business value equals EBITDA times multiple. So if a business has an EBITDA of £500,000 and attracts an 8 times multiple, that would imply a valuation of approximately £4 million. Of course, valuation is never quite as simple as one formula, but this is the starting point for many larger or more established firms. In the current market, many IFA firms are often seeing EBITDA multiples in the region of 6 to 9 times for typical businesses. Stronger firms potentially achieving 10 times or more, and in some cases where lower quality or slower growth businesses, they may sit below the 6 times range. Whereas larger, more scalable businesses with strong infrastructure and growth potential can exceed it. What affects the multiple? This is where advisors often get interested, because two firms with similar turnover can command very different valuations. Why? Well, because the multiple reflects more than just financial performance. Buyers are typically assessing the overall quality and attractiveness of the business. And that will include lots of factors, such as the recurring revenue quality, profitability and EBITDA margin, the client demographics, the funds under management, average holdings per client, owner dependency, growth profile, and operational efficiency. So, for example, firms with healthier profit margins are more often going to be more attractive. Firms that have EBITDA multiples are generally going to exceed £100 million of FUM. Acquirers will also be considering what economies of scale that they will bring and the effect of those on potential uplifts in fees that could be likely. This will often consider not just advisor ongoing fees, but if they are running vertical integration, the likely uplift from moving clients to their own platform or DFM models, where the firm will be adding those revenue streams to their bottom line. Many larger acquirers are typically operating EBITDA margins of around 25% or higher, with stronger businesses often exceeding this. Quite simply, a more efficient business with growth potential is usually a more attractive business. Revenue multiples and recurring income. Not every business is valued primarily on EBITDA. Smaller firms, lifestyle businesses, or businesses without a significant management structure may often be valued using recurring income multiples instead. And in these cases, buyers may look at recurring revenue and apply a multiple to that. As a broad rule of thumb, recurring income multiples often fall somewhere between 3 times to 6 times recurring income, with many firms commonly sitting around the 3.5 to 4.5 times recurring income. Again, this depends heavily on business quality. Client age is only one factor, but it can have a meaningful impact. For example, businesses with older client banks may attract lower multiples than firms with younger client demographics and stronger intergenerational relationships. Buyers are naturally thinking about long-term asset retention. Another factor is average investment holdings per client, where averages that are higher command better multiples. Why efficiency matters more than ever. A major trend in the current market is increased focus on operational efficiency. This is where areas such as processes, systems, and technology can become important. Not necessarily because buyers pay a premium simply for having newer technology, but because better systems often create a more efficient business. For example, lower operational costs, cleaner client data, smoother due diligence, faster integration, and potentially stronger profit margins. Ultimately, these factors can improve the overall attractiveness of the business, and that attractiveness can influence valuation. In simple terms, technology alone does not create value, but a more efficient, scalable, and better run business often does. Valuation is rarely based on one number alone. It is a combination of financial performance, business quality, transferability, growth potential, and buyer appetite. And that is why understanding your valuation is much more than simply asking, what multiple can I get? A better question is, how attractive is my business to the right buyer? The earlier you understand that, the more opportunity you have to strengthen your position. Whether that means improving profitability, reducing owner dependency, or simply gaining clarity on your options. At IFA Acquisitions, we work with financial advisors to help them understand business value, explore succession options, and prepare for future exit opportunities with confidence. If you would like to understand what your business may currently be worth, or how you may be able to improve value over time, feel free to get in touch for a free, no-obligation valuation and recommendations on tailored options to suit your business. And for more insights on valuations, acquisitions, and succession planning, subscribe to our YouTube channel.